Hi everyone, Billy here from iTradingU. Today I'm going to show you a very exciting strategy. In fact, if you've read my blog post earlier this week about people worrying about retirement, this particular video will be of great interest to you. What I'm going to show you is a way to supercharge your returns without gearing up on risk. And that to me is the crucial factor. Having excellent returns without a lot of risk always makes sense. So how will we do it? The strategy I'm going to use today is called an in-the-money covered call strategy. Very easy to understand and very easy to implement. So how does an in-the-money covered call strategy work? Quite simply, you buy the stock outright in the spot market. And at the same time you do that transaction, you also sell a call option. But the strike rate on the call should be in the money. So in our example here, which I'll show you on Netflix, I'm going to buy the stock at $319 and the 2-week call I'm going to sell will be at $270. Because the aim here would be, you would like for the spot rate to remain above your call level so that your option exercises and you deliver the stock against the option, and in doing so, the strategy works and you just bank the premium. So let's look at a real life example. For Netflix, the current share price is $319. Also, if you look at my options quote sheet here, I have all these choices of call options I can sell in the 2-week period. Now, I'm going to choose the $270 strike because to me that offers the most value at this point in time. So by selling the $270 call strike, I'm generating a premium of 51.7. In essence, if you now look at the trade, I bought the stock at $319.54, and if the spot rate can just remain above 270, my call option will exercise, which means I'll buy it at 319, sell it at 270. Now that on the underlying stock makes a negative cash flow. But don't fear, because the reality is you've earned premium that you can account into this equation. Now the premium is $5,170, which means after all said and done, there's $200 in premium left over for you. Now let's look at the amount needed to do this trade. If you trade on margin account, quite often you don't have to put down the full amount. And even though in this example of Netflix, the amounts are fairly large, I do want to remind you that these things occur regularly, and in small accounts, it's really not a problem to implement because quite often you need about $2,000 or $1,000 to put a trade like this on. So it's well within the reach of most of the people listening to this presentation. The margin required on Netflix is $20,900. But for 14 days of investment, you've made $216 return. If you express that 14-day return as an annualized effective return, it works out to 26.9%. That's almost 27% effective return per annum. Now what's lost on most people is, because these type of trades occur so frequently, you can literally just continue to do similar trades throughout the year. And the logic here is if you do these trades consistently, and on average you make, let's say, 20% per year, 20% per trade, then effectively at the end of the year, on that portion of your investment, you would have made 20%. And why does this make sense? Because when you look at your portfolio holistically, this yield-generating engine contributes quite a bit to your overall performance. Now you can see in my example here, I'm assuming you've got a portfolio of $10,000 and you've split it this way. $2,500 goes towards yield enhancement trades. The other $7,500 you use for your normal trading account. You'll see the buffer that the yield enhancements create for you here. So let's assume on your trading account, you only made 15% return. Your return is picked up to 17.75%. Now that is quite a significant adjustment, because remember this, what if you made 5% on your trading account? Look at how nicely that yield enhancement keeps the balance of your overall return high. The first thing you'll see is that I always like to create buffers. Now in the Netflix example, the strike that I chose wasn't at random. That $270 strike to me had value because it means the stock had to drop 16% in the next 2 weeks before I hit that level where I get concerned. The second part is you never ever trade without stop losses. And in our example, we'll put a stop loss on the stock itself, and then once the stock is triggered, you just close out the option at that point. Because for where we are currently, we're not in the game of managing that option exposure. We did the trade for a specific purpose, which is yield enhancement, and once that doesn't work anymore, we just close the trade and look for the next one. So once again, this is a fantastic example of just how valuable options are to an overall trading portfolio. I hope you like this clip. Again, there's comment fields at the bottom of this post, so please feel free to add any comments there, and we look forward to seeing you next time. This is Billy from iTradingU. Goodbye.